broke down. My car broke down, so I've been all over the place. So I haven't had time to do a lot of the questions.
Okay, yeah, I saw just now I got some answers.
Yeah.
Yeah, I'm wondering what are the questions you did, the answers what you have sent to me, or shall I look at those answers later?
We could go through. Well,
Okay.
I've got the ones that we just take. The ones that you just take. I've just circled the answers. So I thought we could go through by if I give you what answer my answer was.
Okay, yeah, yeah. What is the question you did? Can you?
So from the first sheet you sent to me, the question 1 on groups, there's what on what basis that does
subsidiary may be excluded from consolidation. So those are the answers you have sent it to me now?
No, no, I've got the answers ticked here. So I ticked number C.
So we can look at that one. That's good, great. Okay, yeah, we can start on that one. Yeah.
Okay, so I ticked.
I'm recording this lesson, so I can send this recording link for you later on.
Okay, then that's fine.
Okay. Okay. So let's start off with the first question.
I take C.
On what basis may a subsidiary be excluded from consolidation?
Yeah.
Yeah. So the first one, the activities of subsidiary are dissimilar to the activities of the rest of the group. That is not a condition, or that is not something which we can exclude consolidation, wrong. Subsidiary was acquired with the intention of reselling it after a short period of time. With the intention of reselling on one basis may a subsidiary be excluded from consolidation. So a subsidiary was acquired with the intention of reselling it after a short period of time. Okay. Subsidiary based in a country with strict exchange controls which make it difficult for it to transfer funds to the parent. Yeah, there's a restriction, and there you can argue saying there is no control. The final one is there is no basis on which a subsidiary may be excluded from consolidation. Actually, the answer is the fourth one. There is no basis. There are certain exemptions given, but it's not a basis for exclusion.
Okay.
Right. The subsidy of intention of reselling it after a short period of time is an exemption, but it's not a basis. It's not a principle that is laid down saying you can exclude it. In fact, if it's a parent subsidiary, you must consolidate. But there are certain exemptions given, so it's not a basis. So the ACC examiner is sometimes more concerned about the wording and the kind of the exclusion what is thinking. So my answer is D. There is no basis on which a subsidiary may be excluded.
Okay. So in terms of the fact that a country is being restricted, that is not a basis for it to be excluded.
No, that is not a basis. You can exclude it, and you will have to give the reasons why you have excluded it. It's not a blanket exclusion that is there. You can exclude it, but you have to give a reason. You got it?
Okay. Okay, that's fine. Okay. The next one, I ticked B. No, sorry, I ticked C.
Credited profit dollar. That's correct. When negative goodwill arises, negative goodwill means you have paid less consideration than the fair value of net assets. In that case, it will be reassessed, and if there is a negative goodwill, it will be taken straight to the P&L as a credit to your P&L. That is, the acquiring company has got a gain, so that's right. Perfect.
Okay. Okay. And then the third one, I ticked B.
Yeah, B. Which of the following is the criterion for the treatment of an investment in an associate? Yeah, which of the following is the criterion for an investment? Ownership of a majority of equity shares. In that case, it is a subsidiary. First one. Yeah.
Okay. Ownership.
Ownership of a majority of equity shares. That means you have the control. That means it's a subsidiary. Second one.
Yeah, that's a subsidiary. Yeah.
Yeah. Second one also, that is what you had did. That is also when you have ability to exercise control, that means it's a subsidiary. Parent controls the subsidiary. So that is also not the right answer. Third one is the right answer. Existence of significant influence.
But I thought significant influence, isn't that a subsidiary?
No, control is the subsidiary. There are only two words.
Oh,
One
okay.
is control.
Okay.
That is over
And
where
one is
generally the assumption
influence.
is more than 50% you are holding. That is control.
Okay.
20 to
Okay.
49 or 20 to 50, it is significant influence.
Okay.
You are not controlling,
Okay.
but you have a word, you have a
Okay.
say, and that's the right answer.
Okay.
Yeah.
Okay. So the words I'm looking out here for is control and the significant influence.
Control is subsidiary, significant influence is associate.
Okay.
Yeah.
Okay, then that's fine.
Yeah.
Okay.
We will
And then I did number 4.
we will do 1 hour, yeah, because I have a
Okay.
funeral. So say let's 1 hour
Okay.
we'll do it. No problem. Don't worry. Okay.
Okay.
Let's look at the fourth one.
So, the fourth one is I ticked A and D.
A and D. A subsidiary cannot be consolidated unless it prepares financial statement to the same date as the parent. That is what you have done. And the second one what you have done is when a subsidiary financial statements are drawn up to a different reporting date from those of the parent, adjustment should be made for significant transactions or events. So which are the correct when preparing consolidated financial statements, right?
Yeah.
So, the first one, a subsidiary cannot be consolidated unless it prepares financial statements. So the same report is not necessary. You can portion on a time basis. You can take 3 months from the last year and you can do it, and you that way you can.
Okay.
Right. So that's not a something which is going to make you say not correct. Reporting with subsidiary reporting report may prepare additional statements to the group reporting date for consolidation purposes. That is correct. You can't, just because you can't consolidate on the 2 days, what you can do is you can prepare additional statement up to the date. Say subsidiary parent is finishing on September, subsidiary finished up in June. The next 3 months you prepare an additional statement. That is what the IFRS 10 says.
Okay.
So the second one is correct. A group reporting, that part of the thing is correct. Then subsidiary financial statements can be included in the consolidation if the gap between the parent and the subsidiary is 5 months or less. No, there is nothing like that. Last one is correct what you said, where subsidiaries financial statements are drawn up to a different reporting date from those of the parent. Adjustment should be made for significant transactions or events occurring between the 2 dates. That is correct.
Okay.
So B and D are the right answers.
Okay then. And then the next one I chose A.
Yeah. Next one is about IFRS 3. Just a second. Yes, IFRS. I can't see my computer. Let's look at that one. Business combination requires an acquirer to measure the assets and liabilities of acquiring at the date of consolidation at fair value. IFRS 13 fair value measurement provides guidance how fair value should be established. Which of the following is not one of the issues to be considered according to IFRS 13 when arriving at fair value of a non-financial asset? So remember, there are two kinds of assets, non-financial assets and financial assets. Non-financial assets, we can easily measure it. It's like receivables or whatever. Those are what we cash. They are the financial assets. Non-financial assets, we have to measure it. So the fair value, so there is some guidance given by the IFRS 13. The characteristics of the asset is not something what we are looking at. Which of the following is not one of the issues to be considered? Right? Not one of the issues. Which of the following is not one of the issues to be considered in which are one of the issues to be considered according to IFRS 13 when arriving. The characteristics of the asset doesn't matter at all. Whatever the characteristic matters because the financial assets and the non-financial assets are separated. Look at the B. Look at the B. Because what they ask you, which of the following is not one of the issues to be considered? The present value of the future cash flow that the asset is expected to generate during its remaining life. Then the third one, the principal or most advantageous market for the asset, the highest and best use of the asset. I think the right answer is A, the characteristics of the asset.
Okay.
Yeah, because which one of is not to be considered? According to present value, we consider principal or most advantageous we consider, highest and best use we consider. So the characteristics of the asset is something which we only consider. Okay, 6.
Okay. Number 6, I chose C. Oh, sorry, D.
D.
Yeah.
IFRS 10 consolidated provides a definition of control and identifies 3 separate elements of control. Which one of the following is not one of those elements of control? So the ability to, which one of the following is not one of those elements of control? So they're asking the negative side of it. When they are consolidating, we look at the control. We look at the control from power over the investing. So D is right. I mean, D is a way where we look at the control. If you look at the early answer, what we look at, the power over the investing, yes, it's a way we control the company. Power to participate in financial of an operating policy, that means only you can participate, you don't control. That is what we call significant influence. So for me, the answer is B.
B.
B for Bertie.
Okay.
The reason, because you have the power to participate. That is what we call a significant influence. You can't control. All the other three, A, C and D, you are controlling. Power over the investing means you control. C, exposure to rights to variable returns. That means you are getting dividends, different dividends. If you are a preference shareholder, you don't control, but you get a fixed dividend. But when you're equity shareholder, you get different dividends. So C is also a way that we control. D, ability to use power over to affect the amount of the investor returns, dividends, that is also a control. The B is not a control, it's only significant influence. So the answer is B.
Okay then.
Right.
And then number 7, I ticked C.
C. Let's see why.
Yes.
It owns 100% of the share capital of the following company. The directors are unsure whether the investment should be consolidated. In which of the following circumstances would the investment not be consolidated? So, some company owns 100%. The directors are unsure whether the investment should be consolidated. Peter has decided to sell its investment in Alpha as it's loss-making. The directors believe exclusion would assist. That is wrong. You have to, whether you are making profit or loss, it must be consolidated. So that A statement is wrong. Beta is a bank and its activity is so different from the engineering activities of the rest of the group that it would be meaningless to consolidate it. That is also wrong, because we are companies with diversified activities. We must consolidate. C, Delta is located in a country where local accounting standards are compulsory and these are not compatible with the users of the rest of the group. That is your answer, no?
Yeah.
Yeah. That is also not correct. The accounting standard says if the accounting of the other company, subsidiary company are done in with different accounting standard, in order to bring it to uniformity of accounting policies, you must restate and consolidate.
Okay.
Right? You have to consolidate according to your country's accounting standards, whatever. So, in another country, the accounting standards are different. You must restate according to your accounting standards and consolidate. So, C is also a way to consolidate. It's not to be removed, not to be not consolidated.
Okay.
Gamma is located in a
Okay, then.
country where a military coup has taken place and Peter has lost control. Now that is, as we said earlier, it's not a basis. This is a valid explanation to explain because you are not controlling.
Oh, okay.
You are not controlling.
Okay.
Right? So the moment there's a military coup or something and when you have lost the control, you can exclude it, but that's not a basis, but you can explain and say why you have excluded it.
Okay, then. I understand that.
Yeah.
Okay.
Right.
Then I did the group question, which I sent to you.
That is that section C question. Yeah. That
Sorry?
Bob and goes something. No?
Okay. Now I did the question. I did question 8, and then I've done question 9 and 10. So if we look at, I sent it to you.
Okay. That is the,
Yeah, that
the
question.
question she has sent it to me, the 8, is it?
8, 9, and 10.
Let's look at it.
But 9 and 10 are two little ones. So I thought let's do 9 and 10, then we do the 8.
Okay. Yeah, that's good.
So on mine, yes, I've done 9 and 10.
And small questions. Okay. Let's look at the 9
Yeah.
and 10 and then we will come to the next one.
Okay. So for that one,
yeah.
what I did was non-controlling interest at acquisition.
Yeah.
It said they acquired 70% of 200. So I did 70% of I did 30%, which is the non-controlling bit of 200.
Yeah.
Times the market rate, which was £1.75.
Okay.
So I had 105.
Okay.
And then the share of post retained earnings.
Yeah.
I did 30% of the retained earnings at I used the 750.
Yeah.
Because where was the 750? Where is the 750?
750 is the asset, the balance sheet date. Retained earnings are 750.
Yeah, so I used the 750. Is that correct?
No.
And then
because you have to look at only the post-acquisition profits. So when they acquired the company, they had retained earnings of 450.
Okay.
And now
so
it is 750. You must take only the difference, 300,000. 30% of that is your post-acquisition non-controlling.
So I'll take you said I'll take which one? Sorry, say that again.
750 minus 300.
Where did I get the 300 from?
750 is the closing balance. At the day that they acquired, they had 450.
Oh, okay.
So the post-acquisition is 300,000. Of that, 30% is 90,000. Plus the other 105,000 is all right. That is the initial investment value. 200,000, 30% at 175. Then what did you do? Anything else you did? Or what was your answer?
My answer was 225. Oh, sorry. My answer was, no, hang on. It was, I didn't calculate it properly actually. That's 10.
Okay, don't worry.
That should be 320.
Yeah.
But I didn't deduct the 450 from the 7.
Yeah, that you have not done, and there's another adjustment.
Okay. So it will be.
Yeah, let me see your answer. What we have done.
It's that one. That one there. The first one.
Yeah, 105 is all right. The post-acquisition profit is 30% of the post-acquisition. So at the day we acquired, they had a 350 profit. and then sorry, so, what was the profit on the day of the acquisition? On the day of the acquisition, they had a 450, and now it is 750, so 300, 105. That is all right. Then on the 330%, 90 is all right. So that where you went a little bit wrong. And then there's a little bit of a thing what we have to do on that excess depreciation. The carrying amount of the asset at the date of acquisition are equal to their fair value, apart from a building which had a carrying amount of 600,000 and a fair value of 850. So there was an excess fair value of 250. So our assets would have been valued, even though in the company it appeared at 600, it was valued for the consolidation purposes at 850. So when we value it at 850, that on the 250,000 excess, there is depreciation, and they say the remaining life period is 40 years.
40 years.
So every year, 250 divided by 40, there will be additional depreciation, which the subsidiary will not provide it. Because subsidiary will show it at 600,000 and will go. So every year, 6.25 additional depreciation will come. So when did we acquire? We acquired it on 1st April 2008. We acquired on its subsidiary on 1st April 2008. Now, what is the date? We are now preparing the financial statements at 2009.
Okay.
So 1 year has gone. So on the 1 year, we will provide additional depreciation of 250,000 divided by 40, 6,250. Correct? 250,000 divided by 40. Of that, 30% goes to the non-controlling interest.
Okay.
So 6,250 minus 30%, 6,250, 30% of that is 1,875. So it is 105,000, 90,000 minus 1,875. Why?
So when you're doing that in the non-controlling interest, what would you put it down as?
You will debit it to the non-controlling interest straight away.
No, yeah, but normally when you're doing because for the formula for the non-controlling interest, when you're doing a group account, I thought it was your
original cost of investment, our share.
Sorry?
Original cost of investment, the non-controlling share, plus the post-acquisition profits of the non-controlling, minus any dividend.
That's not an impairment.
Pardon?
This is not an impairment.
This is not an impairment. This is because we have valued the asset at a price higher than what is appearing in the company's subsidiaries book. There is excess depreciation.
Okay, so we can just put it down as depreciation.
It is excess depreciation.
Okay.
Also another one, as you rightly said, it is the impairment. Impairment, if the goodwill is valued on fair value method, or the non-controlling interest is measured on fair value method, then the impairment also should be taken in. Then also there can be intercompany transactions happening. That also must be taken in. And then also the next one is intercompany impairment, fair value adjustment, then the dividends paid. Subsidiary paid a dividend, that also their share should be deducted. Two additions, two pluses are original cost of investment plus the post-acquisition profits.
Okay.
So it is 105 plus 90,000 minus 1,875. 193,125 should be the answer.
Okay.
Yeah.
Okay then, thank you.
Right.
And then I did number 10 as well.
Let's look at the number 10, yes. What is the answer you got?
Number 10, well, I got more than that one. I got what I did. I got 763. I did the cash consideration.
Yeah.
Then I did I sent it to you, so it's on the bottom of the other one.
Okay, let's look at that one. Same question at the bottom, this one.
Yeah. So the cash consideration of 250.
Okay.
Then I did the deferred. Oh no, I shouldn't have added the deferred, isn't it? Because you're not paying it now.
Consideration should be added. You are right. Deferred consideration should be added. We have to see.
Should be added.
Yeah. So that 69,000 is correct. Yes. Not the 69,000. No. Deferred consideration got 44. No. So that we will see how we got the 44. We will
and
look
then
at.
I did the
Share
share bit.
69,000 is correct. So 250 and 69 is correct.
Yeah.
Fair value of the non-controlling interest 400 is also correct.
Okay.
Yeah. So because what they ask you, let's look at what they ask. So the two figures are correct. Yours 250 is correct, 69 is correct, 400 is correct. Okay.
Yeah, I think I didn't take out the
Because you had the value of the fair value of the assets.
Yeah, that's what I didn't take out.
Okay. Not taken it out. So 250 plus 69 plus the 400 is all right, but the deferred consideration, let's look at how you worked out. When the retained earnings were consideration comprised 250,000 cash, 400,000 payable on 1st January 2009. So not today, they are going to pay 1 year, they are taking it on 1st January 2008, they are paying 1 year later. So you have to take the time value of that money, total consideration. I don't know why you took a small portion. The total consideration is 400,000. That is if you have paid it today, but you are not paying it today. You are paying it 1 year later. So you have to take the time value of money. So 400,000 divided by 1 plus R. R is the interest rate, which is 0.8, 0.8. So 400,000 divided by 1.08 is your consideration. Deferred consideration. So 250.
Okay.
1,000 plus 370. That is the value of 400,000 divided by 108 plus the 69,000 is your total consideration what you pay, which is 689,370. Then we have the NCI valued at fair value 400,000. So 1,089,370. Now we have to look at the fair value of net assets. So the net assets are the total share capital of the company, which is 100,000.
Okay.
And the retained earnings on the day was how much? 850,000.
Okay.
So 1,000,000 not 89,370 is your total consideration. The value of net assets are share capital plus retained earnings, which is 850. So when you deduct that one, you will get 139,370.
Okay.
Is it clear?
Okay, yeah, it's clear.
Yeah. So always remember that whenever there's a deferred consideration, if there's a timing difference of more than 1 year, you must take the discounted value of that money.
Okay then. Okay. And then I did the long question, the number 8.
The long question, yes. What are they asking in the long question?
They wanted consolidated income statement and statement of financial position.
Profit or loss and other comprehensive income and statement of financial position. Group policies to value non-controlling interest at acquisition at fair value. Value of non-controlling interest at the date of acquisition was 600,000. So let's look at your P&L you did. No?
Okay.
First let's look at the P&L. This is your P&L?
No, this is
yeah, consolidated.
Yeah, that's the P&L. Yeah, that's the P&L.
Yeah. So revenue you got 5 million, 1 million, and 80. 80. Cost of sales, so only 2 million 920, 2 million 900 plus 600 plus 80. What was that 80? I want to look at that 80. What is the 80 you got?
It's supposed to be an intercompany. So it's under working.
Yeah, intercompany you deduct it. Intercompany total sales must be deducted only for the cost of sale. Unrealized sales profit should be added up. Understand? All intercompany.
Say that again, please.
Yeah, whenever there is intercompany sales happening, when you are preparing the income statement, from the total, from the cost of sales and the revenue, total intercompany sales must be deducted. So in this case, the total intercompany sales came to 100. How much was the total intercompany sales?
It was 100.
100. The entire 100 must be deducted.
From both?
From both, from the revenue and the cost of sales.
Okay.
So your revenue will be 5 million plus the 1 million plus minus 100.
Okay, it should be minus.
Minus in both, from both sides, because when you sell, I'm the parent, you are the subsidiary. When I sell to you, my revenue is overstated by 100,000.
Okay, okay, understand.
And in your cost of sales, you have overstated your cost of sales by 100,000. So both must be deducted. But having deducted that one, if there is any unrealized provision, the unrealized portion, that must be added to your cost of sale.
So the 20 should be added back
to the cost of sales. So the cost of sales will be 2920. Sorry, 29 plus 600 minus 100 plus 20.
Plus 2. Okay then.
Right?
Okay.
So that is the adjustment you will do.
Okay, and then where does the other side of the 20 go?
It goes to the inventory. It reduces the value of the inventory.
Okay then.
Because the inventories are overstated. When you add up both the inventories, inventories are overstated by the intercompany balance.
Okay.
So that should be removed from the inventory.
Okay then.
Right? Other expenses 2020, you are correct.
Sorry?
Other expenses 2020, that is 17 plus 8, 20, that is correct.
Okay.
Taxes 155, you are correct. And this is the advantage in these big questions. You will get marks for those areas.
Okay.
Yeah. So up to that point, yes, profit before tax, then tax is all right. Then you arrive at your other, so 599660 cost of sales is, you have made another mistake. You had added the cost of sales.
Where?
It's not.
I'm supposed to deduct it.
Yeah, cost of sales should be deducted.
Oh, that's always the tricky one.
Yeah, cost of sales should be deducted. Yes, other expenses should be deducted. Tax should be deducted. Then you will arrive profit for the year.
Okay. Right. Yeah, I know that one.
So that's all right. Then other comprehensive income 20 is all right. That is good. Now from there, we have to look at this second part is the very important one. What we have to do it very carefully. So shall we go back to the question and do it? Now you know the mistakes what we have done, no?
Okay. Okay then.
Let's go to the question. I want to do that balance part of the question with you.
Okay.
So revenue will be 5 million plus 1 million minus 100. The revenue will be 5.9. Cost of sales will be 2,900,000. plus 600 minus 100 plus the provision for unrealized profit 20.
Yeah.
Which will give you 2420. 3420, sorry, 3420, 2935, yeah, 3420. So you will arrive at your profit of 2480.
Okay.
Then you deduct your total other expenses of 17 plus 320. 2020. Then you arrive at 460.
Is that profit before tax?
Yeah, profit before tax 460, yeah, correct. Okay. Then the tax is 155.
Okay.
So then you arrive at 465 minus 155, 305.
305. Okay.
So this is what we call profit for the year. Profit after tax. Then we have other comprehensive income of 20. So then we say total comprehensive income or TCI 325.
Okay.
Right. Now we have to look at the distribution. So we have to look at what we do is we look at the first of all the 305 figure.
Okay.
Right. First of all, we have to look at 305. How much of that is attributable to the non-controlling interest?
Okay.
Right. So the non-controlling interest in this company is 20%. So what we have to look at is look at the profit of the subsidiary company. Subsidiary company profit is 55. On the 55, 20% is non-controlling. Now we are consolidated. So out of 305, 11 belongs to the non-controlling.
Oh, so what did I do then?
Yeah, that is what I was trying to find out. What you did. Can we look at what you did? Because I think you took the entire 305, if I'm not mistaken, you gave the entire 20%. Do that.
It is on the, yeah, that's the bottom bit. So I did, please.
No, this one, not this one. No, that's what I balance.
No, it's the one and number 5.
Oh, number 5. Income statement 55. What did you do?
I just took the profit from the
from the subsidiary. All right, that's all right.
Okay, so I need to do a percentage.
I think, yeah, that's what you did. That you don't do it there. Right? You don't do it there because you take because the question says, despite goods at in invoice, receive the goods on reduce that the boo acquired 80% at the date of acquisition. Good the dispatch goods which cost 800,000 receive the goods. All right, that is two companies' financial statements are there. What are they saying later on? Art and statement. It is the group policy at the value at fair value. The fair value of the non-controlling. Right, you're right. Okay, that's all right. Because it is fair value. Right? Because it is fair value, and what you have to do is you take but the problem is that as far as the group is concerned, the later on we will take that thing because now we added up the entire 55. The parent company has added the 55. Who is selling to whom? That's the important one. If the subsidiary sells to the parent, you must deduct it.
Okay.
Now who is selling here? Goose on 31st December, Boo dispatch. Parents selling to the subsidiary.
Okay.
Understand? If the subsidiary has sold to the parent, what you did was correct. When the parent sells to the subsidiary, the intercompany profits are not in the subsidiary books, it is in the parent company books.
Okay.
So because of that, you don't need to deduct that 20 from the subsidiaries thing. You take the entire 55, take 11, 20% of 55.
Okay.
So out of 305, 11 is the NCI. And the balance in figure 294 is the parent figure.
So for when you're doing the non-controlling interest, you only take the percentage of the non-controlling interest of the profits.
Yes. Yes.
Okay.
Yeah.
Okay.
There are 3 deductions normally that comes up. In this case, it is not happening. One is if there's a goodwill impairment, from that 55 we have to deduct the goodwill impairment.
Okay then.
Second one, if the subsidiary sells to the parent, that must be deducted.
Okay.
Third one, you remember that excess depreciation. If there was excess depreciation, that must be deducted from the 55 before we apply the 20%.
Okay.
But here, none of those things are there. Even though intercompany sales, it is the parent selling to the subsidiary, and therefore no adjustments to the non-controlling the subsidiary profit. So just take a note down on the subsidiary company profits. Out of the subsidiary company profits, 3 deductions are done. Number one, if there's a goodwill impairment, that is deducted. If subsidiary sales to the parent, intercompany profit is deducted. If there's excess depreciation because of the fair value adjustment, that is deducted. And after that, you take the 20%. But in this case, none of those are there, and therefore, out of 55, 20% straight away you will take it.
Oh, okay. So if we have those adjustments you just mentioned, the 3 adjustments, we do that first.
Do that
then
first,
we take
and then take 20%.
Okay then.
So, for example, if the subsidiary is sold to the parent, 55 minus 20, 35, 20% is the right way to do. That is what you did.
Okay then.
Right.
Okay then.
So having done that one, so now it is as far as the 305 is concerned, those are the figures what you have to do. Then you have to look at the total comprehensive income. What we can say is the revaluation belongs only to the parent. So because of that, there is no adjustment for the NCI. So as far as the 325 is concerned, still it is 11 to the NCI, 314 to the parent. Because remember that the revaluation, it's only the parent.
So 11 to both, is it?
No, you remember when we worked out the first part, before the other comprehensive income we worked out, NCI share was 11, parent share was 294.
Okay.
Now,
where's the 294?
That is 305 minus 11. 305 is the total figure.
Okay, yeah. Okay.
You balance it. The balancing figure is the figure we take as 294.
Okay, yeah, understand.
Then we come to the second part, the 325. Of the 325 figure, in this case, the entire other comprehensive belongs to the parent.
Yeah.
So because of that, one way, just take the 294, add the 20, 314, NCI no change.
Okay, yeah, because that's only for the parent.
Only for the parent. For example, if there was a figure here, say if there was an NCI figure of 10, then 20% of that also will go to them.
Okay then. Okay then.
So those are the few things you have to learn it. So the income statement up to that point, it's all right.
Okay then. Yeah.
So shall we look at the balance sheet? Financial position, what you did.
Okay.
Did you do the balance sheet?
Yeah, I did it. It's behind. Yeah, I did it. You brought it up a minute ago. Hold on. Yeah.
Is it the income statement?
Nope. That's it. Income statement. Shit. Have you got it?
Intercompany dividend.
Let me see. You haven't got it?
That 5 statements. I don't see.
Let me just see.
Yeah.
I thought I sent it to you.
There were 5.
Let me just
1,
send
2, 3,
it.
4, 5.
That isn't it. Hang on. Let me just send it. I'll send it again.
Okay, right.
Hopefully.
I got it just now. Okay, let's look at that one. So assets here, total property, plant and equipment 2140 is correct. Goodwill, you got 650. Let's see where we went, where problem with the goodwill. So I want to see the goodwill working. Goodwill working, have you sent it earlier?
Yeah, I sent it. No, that's not it.
Right?
No, that's not it. Yeah, that's it there.
Then it's yes, that's correct. Yes, you got a goodwill of goodwill. Let's look at the working of the goodwill. So they have 80% control. Goodwill is 300 correct. NCI fair value 60 is correct. 360. You have added. That's a mistake.
No, I added it, isn't it? It's,
It
yeah,
should be
I've
deducted.
just seen it.
It should be
It should
deducted.
be deducted. Yeah, it
The
says
figures are
less
correct.
fair value.
The figures are correct, right? 300 plus 60 is the consideration. The fair value is 190 and 100. You should deduct it. 360 minus 290. Goodwill should have appeared at 70.
Okay.
Yeah. You just added.
Yeah.
You have to deduct it. That's all you have to do it.
Okay.
So goodwill should be 2. Goodwill should be 70. So that should be all right. You will get some marks for these things because examiner will think that we have made a careless mistake and will give marks if when the workings are there. Inventory 500 plus 120. Inventory plus 500 plus 120. There was a 500 plus 120. What about that? There was some goods in transit. No, there.
No, there wasn't good. They didn't say there was any. Did they say they didn't? It said it received the goods on the 2nd of January.
So our accounting date is on 31st December.
Yeah, 31st.
December.
So I suppose
So
all the goods were in transit then.
goods were in transit. So you should have added that one.
So would that be the 100? No, the 80, isn't it?
80.
Yes.
Yeah, the 80,
Okay.
the 500 plus the 120 is all right, but the goods in transit should have been added the 80.
Okay, and then what about the profit?
What is the unrealized profit? That must be deducted.
So the minus 20, is that correct?
Minus 20, yeah. So sorry, 520. Received 520, 500 plus 120 plus 100 minus 20.
Okay, so it should be plus. So what I did, was that correct then? Because I did the minus 20 and then plus, I've just added the plus 80. It works out.
So what's the figure you got? Plus 80 should be plus 100.
Sorry?
Should be plus 100. Total assets 600. You have added 500.
Yeah.
Plus
And then
120. You have taken the minus 20, but you have not added the goods in transit of 100.
Oh, okay then.
Yeah,
So the goods in transit.
the three figures are correct, but you have not taken the goods in transit of 100.
Okay.
So the total figure should be 700.
Is the goods in transit 100? Because I thought it was the profit. It was the profit
No,
that it was 80.
transfer is transferred at the selling price.
Okay.
You acquired 80%, 31st boot dispatched goods which cost 80,000, invoiced at 100. So when they
Oh,
invoice it at 100, it will appear in their books at 100.
at
The
100.
other company also will take it at 100. So therefore,
Mm-hmm.
it should be recorded at 100, not at 80.
Okay. Okay.
Because we are taking
Okay then.
intercompany profit separately.
Okay then. That's fine.
Right. Otherwise, we should not have ignored. We could have ignored the intercompany and taken as 80. But in that case, you
Mhm.
can't take the 20 off. Understand?
Okay.
Either way, you
Okay.
can do it. So it should be 700 altogether.
Okay.
Then we have the trade
Great.
receivables. Trade
Mm-hmm.
receivables, we have an adjustment there. So what you did was 650 plus 40, not the 80. Not the 80. Now there you are on in making 80. It is the 650 plus the 40 minus 100, because the trade receivables in your books will appear at 100, not at 80.
Okay.
When you sell it to me, in your books the receivables will be at 100, isn't it?
Yeah.
So you will have
Yeah.
to put it at 100. Even my trade payables will be 100. So it is at
Okay.
the selling value, I had to take it up.
Okay.
So
Okay then.
then what about cash and bank balances? You have not taken in. That should have come.
Oh, I
Hmm?
forgot to put that one. I
Yeah,
didn't see
yeah.
that one.
You have to put the cash and
So
bank
cash.
balances. Yes.
Yeah.
So
Cash and
share
bank.
capital of
Okay.
equity is 2 million is all right. That's all
Mm-hmm.
right. Retained earnings. Now retained earnings, surely obviously your figure may be wrong. But let's see how you worked out the retained earnings.
Okay. Yeah.
Retained
That's it.
earnings, yes. Yeah, let's see how we got the retained earnings. So as far as the because there will be some mistakes in your figures, that's all right. So parent company per question, retained earnings, how much the what is the top figure you have?
It's 25 is from the as per question.
Yeah, let's
2520.
2520. Oh, that's wrong. That is including the share capital, 2520.
Oh, so I
Retained
should take
earnings
the share
are
capital.
only the retained earnings.
Okay. Okay then.
Take only the retained earnings of 500.
Okay.
Okay.
Bless me. Okay.
Why? Then
So then I don't add the revaluation.
evaluation is a separate one. That's not retained
Okay.
earnings. That should be
Okay.
shown separately.
Okay. Okay then that's fine.
So 500 is all right. Then
Mm-hmm.
the 20 should be minus. That is correct.
Mm-hmm.
Right? Minus correct. Then of course your pre-acquisition, post-acquisition profits calculation is wrong. Otherwise you would have got the method is correct. You should be getting 80% of that one, which is correct. The calculation was, your answer was wrong, and therefore you have got a wrong one, but otherwise you would have got a 55 here, 55, 80% would have come up here.
Okay.
Not 55, 50, right? 50 because it's 240 minus, the top figure is 240.
Which
Yeah,
one?
top figure 340,
It's yeah, it's 340.
Where is that 340 coming? Let's see what is 340.
It's supposed to be from the question as well. It's supposed to be 240, but I wrote
Ah,
340
that's
because I added the share capital to
all
it.
right, okay, that's correct. Otherwise, it's correct. 240 minus 190, 50, 80% of 50, you will add it up. So method is correct.
Mm-hmm.
Method is correct. Only thing, that calculations are wrong.
Okay.
So share capital is all right. So that's okay. Revaluation surplus, show it separately. Yes, that's correct. What you have done is correct. Revaluation surplus, you keep it just 20, that's all right. Keep it
Yeah.
separately, that's a separate one. The non-controlling interest,
Well,
I think, yeah?
Yeah, I understand you.
Yeah, non-controlling interest, I think you went wrong because of the figures. Otherwise, its calculation is all right. Then the current liabilities, again, trade payables, 9, 10 plus 30, that's all right. Right, because other people have not received the goods, so you don't need to deduct it from them. So they don't show it as payables because it's goods in transit. Tax 150 plus 20. 150
I think
plus
I did that wrong. I was
yeah,
supposed to put that 80.
yeah, what is that 80? 80 something, no? What is that 80?
No, it's 80. I think the 80 was, I was going to put it at the payables, but you said there shouldn't be
No,
anything at the payables.
it won't come anywhere because the goods have not been received, no? If the goods are received, you will show it as a 80 not 80, 100 payable.
Okay.
But since the goods are not received in the subsidiary books, there won't be any trade payables.
Okay.
But it should be, the taxes should be only 150 plus 130 plus 25.
Okay then.
Okay, so I think it's all right. Few areas to be corrected. So we will look at more of these things. I will send you some of the answers for what I have done for these things with the workings.
Okay.
So you can just have a look at and see where you were to adjust it.
Okay, and I'll do the rest of the questions. So hopefully I'll be done.
When can we meet again, Yaba?
When are you available? I suppose next Saturday.
Yeah. Yes. All right. Next Saturday.
Yeah, we try and see if we can do an hour and a half then.
Okay. No. Next Saturday, definitely I can do it. I will do it definitely for you. Yes.
Okay.
Yeah.
Okay, I'll do next Saturday so that I can go through the questions.
Okay.
Okay then. Thank you very much.
So Saturday, shall we make it 11 o'clock same time?
Yes, please.
Okay, so we will make it Saturday 7 o'clock. I'll keep 1.5 hours for you.
Saturday 11 o'clock you said. I thought you said 7.
11.
Okay then.
Yeah. Okay then. Thank you. Take care. Have a great day.
You too. Bye.
Bye.